Hello, YouTube. This weekend we have a lot of pain going on in the market, and one man's pain is turning into another man's gain. We can note that, again, the pain that is currently felt is that the market's been going straight up, and the people who manage a lot of money are on the wrong side of the trade. This weekend we have the pain trade setting up a key decision where we're going to have the bears or the downtrend meet the bulls or the uptrend right around the 50 weekly moving average, which for us historically has acted as either the confirmation or the rejection, which leads to either a new bull market or a monster bear market bounce, which leads to more downside. Let's briefly explain what that means, and then we're going to jump in and have a look at a lot of things this weekend. But actually, I'm going to jump forward to explain things a little bit different. Then we'll look at the charts in a moment here. And again, if you're enjoying the video, I would really appreciate a thumbs up. Drop me a comment and let me know what you think is going to happen this week. So this is from Monday, an explanation of the pain trade on Wall Street and why today it is for stocks continuing to go higher. And what happened? S&P went up by 3.3%. That is a big week. Remembering that S&P normally only goes up by about 10% every year. So we did the equivalent of roughly 3 months worth of work this single week. That is massive. Why did we do it? Let's go back in time a little bit further. Let's go back to July 19th, which is what? It is the day we basically had the Feds, and then we went straight up in a fat move right here. So this happened on July 18th. Again, ironically, the day that we had that investor alert that we mentioned, I think, 2 weeks ago on the video. And then the next day, July 19th, article comes out. This is after the Fed have had their meeting. So what happened? Well, what happened is that people are on the wrong side of the trade. So they are positioned, they have the lowest allocation of stocks to levels not seen since 2008, while exposures to cash are at the highest since 2001. And this really matters because when we look back in time, and again, history serves as a guide. The saying is that history does not repeat itself, but it rhymes. And I want you to pay attention to two lines right now. The first one's going to be the blue line, which is going to be the short-term price or the 50 MA. And the black line is going to be the long-term price or the 200 MA. And we can note that we were above the 50 MA, we lost it and came down really close to the 200 MA, and now we're bouncing up to re-meet it. And the 200 MA is called the Fed put. So the Fed put means when they pivot or when they start to support stocks. So that, or again, like start selling puts, not to overcomplicate it, it's when the market goes back up. And because we are right now, right around that blue line, the big decision is going to be whether or not we're going to reject on it or we're going to go higher. Why? Again, just to make sure this is crystal clear. The reason why I was really bearish, like I thought 2008 would happen, was because the underlying fundamentals were now quite bad. Things have changed. And if people are positioned like 2008 or 2001, if the chart is now showing that we're not going to repeat what happened back then, maybe we're set for continuation. I'm talking a big move. So again, just look at the black line, look at the blue line. We went roughly to the black one, came all the way back up. Now let's go all the way back to 2000 and 2008. And then we're going to look at the other times when the market actually did birth a new bull market. So the pain trade is that the big money is positioned like we're going to dead cat bounce, reject once, the dead cat bounce, reject a second time, and then we have most of the drop. This portion here is not nearly as big as the second part. This is about 2/3 or 3/4 of the total losses. Just like in 2008 here, where we have the all-time high, we lose the 50 MA once, briefly fall back above it, bounce off the 200, and now we're roughly where we are right now. And again, positioning right here for this size is dramatically lower than the positioning for this size. This is the nasty cut. That's the deep recession. That's the stock market drop of 50%. And right now, again, money managers and fund managers are positioned like we are going to get this big, nasty move lower. And as of right now, it appears like there is more evidence that maybe it's not going to happen, or maybe we're delaying it. So to not overcomplicate things, we lose the blue line, come down to roughly the black line or go below it, and then we bounce up. And the key decision is right here, where we fail to get back above the blue line. Basically testing it and then falling back down. Falling back down is basically means we're going to self-fulfill and go into that deep recession. Same thing happened here in 2008. We lose the blue line, test the black line, come back up to the blue line, and there's a kiss of death, which means we touch the line and then reject. And that is where most of the losses come. We can also look at the next leg lower, and then it just never really recovers. So now I want to show one more thing. We're going to look back at today, and then we're going to look at other times when a bull market was actually birthed. So next thing I just want to look at is going to be the death cross here. The death cross here happened in September 2001. Death cross happened here in October of 2008. And that just means that momentum is pointing down because the short-term price is now below the long-term price. And if we look at this area here, that was pretty much the confirmation. In terms of time, all-time high to death cross to the low. There's much more time on the death cross portion than there is on the first drop portion. Same thing which happened in 2008 here. So we look at the amount of time that we got from roughly October 2007 to August. Yeah, well, this one's actually almost 50-50. This was a nasty drop, though. Happened very suddenly. Again, that was the great financial crisis. So now let's go back to today, and let's see whether or not there's any similarities. Again, keeping in mind that history does not repeat itself, but it rhymes. So now I'm going to delete the lines, and we'll bring them back in a moment. But just looking here, we were uninterrupted above the blue line, right? Straight up. Come back down, lose it once. Try to reclaim it, just like in 2008. Lose it officially, almost get down to the black line, and then we curl all the way back up, and now we're meeting that 50 MA. So if we're able to get above, that means we're invalidating the pattern. It's that simple. Literally that simple. So now let's look back at times where this did happen, where we didn't go down by -50. We had shallow recessions or shallow drops, meaning a -20%. So now we look at, okay, one more thing to point out here, just the death cross, because I know we just looked at that. So let's go back here and have a look at the death cross. Another reason why this might be a little bit early is because the blue line is curling down so slightly. It's going to take a long time for it to meet the 200 MA, which is also curling up really slowly. So maybe that'll happen sometime in 2023. If that happens sometime in 2023, that would correspond with us delaying the inevitable later. But for right now, we can sing Kumbaya and we can celebrate because the bulls are in charge and there ain't no party like a bull party. So going back in time to confirm times when we had an uninterrupted bull expansion, we're now going to look at starting in 2011. We note here that we now get the golden cross. Oops. So we get a golden cross, which pretty much means that momentum is building back up. We get back above both the blue line and the black line. And what happens? Man, we go up a lot. From 2011 to 2015, we go up by about, right, from peak to trough, or trough to peak to trough, 100%. We double up. Do you like doubling your money? If so, smash the thumbs up. Drop me a comment. I'm trying to help you lose. I'm trying to help you avoid losing and make money. Now let's look at 2016, which was, I believe, Brexit. Maybe not. I'm actually not sure right now. So again, we go below the 50, test the 200, get back above the 50. What happens? Bull expansion. How much do we go up? Quite a bit. We go up by about 62%. All right, and we got 2018. Oh my God, that was terrible though, Justin. Do you remember? Yes, I do. I was trading. Lose the 50, test the 200, get back above the 50, uninterrupted until what? Well, everyone knows what happened in 2020 here, right? Right. The sickness took over, and it looks like the sickness might be done now. Anyways, let's repeat the same process here. So we lose the 50, go below the 200, reclaim the 50. What do? Oh boy, booms, right? We go up big times. And people did not believe it then, just like people do not believe it now. We went up by 120%. So again, keeping that in mind with a fresh perspective, do you see evidence now that maybe fundamentally we can pick up where the technicals already are, where all we have to do now is just get back above the blue line and then not lose it? And that's when it becomes a self-fulfilling prophecy. The pain trade turns into the greed trade. So let's continue the story now. So now we understand the reason why this is so important. And I don't know how many times I've recycled and shown this article because it encapsulates exactly what I think. And if we think about that 200 MA and the 50 MA meeting for a death cross later, that pretty much aligns with what I'm looking at here, which is our psychology chart. I'm not going to repeat myself just because I talked about this a lot, where I still believe that ultimately we will get that deep recession. But I think it's going to happen sometime in 2023, which is when we get our key decision here on the apex. So until this monthly chart gives me evidence that tells me that we're not continuing to make progress, I'm going to believe it. And when we look here, again, on the monthly chart, the green bars are actually bigger than the red ones. I would also note a really important area here, which is going to be this pink box. And what the pink box signifies on the monthly chart here, removing the lines, is just that before we can make new highs, we have to take out the lows. So if we look really close here on the monthly chart, we've now gotten through, right? We have to go in reverse order. So we took out the June low, we took out the May low, we took out the April low, we took out the March low, we took out the Feb low, We took out the Jan low. Oh my God. So we took out all the lows from 2022? Yes. Correct. So now what we can battle for are going to be the highs, which right now we're going to be here at 430, which is also what? Oh, that's like a really important area. Yep. 430, really important. We'll talk about that in a moment. But that last thing I want to look at is going to be the last lows to get at here. We're looking at Q3 of 2023. So we're looking at, this is actually Q2. That's going to be 42197, already claimed it. Then we got 426 and 428.78. So an easier way to look at this now that you understand is, oh, so we are above Q1 lows. We're above Q2 lows. We're above Q1 lows. And we're now back above Q3 lows. That's correct. We're above all the lows, which means we're what? We're set to make higher highs. If we can claim roughly 430 here in the chart as well, which could be a head and shoulders pattern setting up, we're pretty much getting the green light here to keep going higher. Will it be a straight line? Probably not, but let's look at a little bit more evidence after we look at a few more articles here. So BofA survey shows indicator remains at max bearish for the 9th consecutive week, which means that people are still not believing this. They don't believe it. And we're at a point now where the self-fulfilling prophecy of a new bull market could be birthed if we can get one more point to push us into greed. Because then it means that people who are sitting in cash on the sidelines are now going to actually start to slowly rotate from being the most bearish or max bearish to being maybe a little bit less bear, then maybe a little bit less bear, then maybe neutral, then God forbid, greed or bull. So at a high level, why bull or why bear this week? Well, Fed pivot, shallow recession over the short-term price or the 50 DMA, and now flirting with the 200 DMA and the 50 weekly moving average in sight. We'll talk about that in a moment. 454, unpenetrable fortress, which is still our massive head and shoulders neckline. DXY and TNX breakouts. Mixed data on that one this week. Deep recession risk, looking a lot less likely. And then Tara. There are reasonable alternatives. Other things to keep in mind are just going to be the surprises for this week. And I am looking at Wednesday at 2 p.m., which is when we're going to get the Fed meeting minutes. I don't think it's going to really move the needle because we've already heard from all the commentary. But again, if we're looking for a catalyst, it might be that. It might be European CPI on Thursday, or it could just be monthly OPEX, which is going to be monthly expiry. There are call options going up to 435 for Monday. And now we're going to tie this all together and look at some levels now. So look at the levels, we'll look at the chart, and then we'll continue with the show. So we look here at the levels we're at right now. So currently in center field, we're looking at 421, 415, and 412 for support. Those are going to be the monthly lows we just talked about. 421 and 415 are notable. 412 is a massive pivot and roughly a weekly higher low for this week and also the Fed low. So it's kind of really important at 412. If we're going to keep the momentum, we have to continue putting higher highs and higher lows in. In terms of resistance, we got 429, which is going to be that September low. It's 428.7, but we're going to round up to 429. We got the psychological 430. Then we got 432, which is going to be our 200 DMA and 10% off the all-time high or correction territory. Then we got resistance 3 at 435, which is going to be our 50 moving average roughly and 20% off the lows. So now let's explain on the chart what that means. So we've talked about QQQ quite a bit in terms of it actually being out of bear market territory and also out of it's now in a bull market because it's 20% off the lows. But for the bigger market, which is SPY, we're now going to also look at math. I know that pesky thing called math that people just kind of their eyes gloss over when we talk about it, but let's talk about math for a few minutes here. So if we look at where we were from the high to where we were at the low, going down by negative 20% means that technically we had our bear market. We had our we had our negative 20% dip, which was at about I think it was 383, 384. So once we got to 383, 384, we enter correction territory. We've now retraced more than 50% off the high, and all this means is that going from the high so as we're going down, the progress is made from going down by negative 10 and then negative 20. So if negative 10% is currently at about 435 from the all-time high, if we now are also 20% off the lows, it means that technically we're in a bull market out of correction territory, and that's how we can continue to go up, which is another reason why this blue line is going to be so important this week. So again, from here, 480 on the all-time high to roughly 432, that is 10% off the highs. We're now at 427. We go up by roughly another 1.5%, and we're there. On the flip side, for the gains off the low at 362, for us to get to 20% off the lows or birth a new bull market for the S&P and not just the NASDAQ, we have to get to roughly 434, 435. So an easy way to think about it is if we can also get above the 50 MA and close above it, we are out of correction territory and we are in a new bull market. Cool. What led us there? It was QQQ. So now if we think about QQQ, I already have the numbers on the chart here to keep it a little bit more organized. We went down to -30 or the pink line instead of going down by -20. Now, we also are up by 20% off the lows or to 323.14. We're currently closing at 330 on Friday. So we are above 20% off the lows. And we are also above that bear market level or the blue line being 20% off the highs. We go down by 20%. So right now that is at 326.97. We are also above that, which means that we are out of bear market territory in a bull market, but we will need to get out of correction territory to confirm that this is real. So from the high that we have here at 408, I would note that negative 10 off the highs is going to be about, come on. Negative 10 is going to be at 370-ish. So 365, 370. Let me actually just do the math here. So we got 408.71 times 0.9, 367.84. So if we can get above 368, it means that we are now out of correction territory as well. And S&P will be above it. And then it's all gravy, baby. Whoop. So if we can reclaim the 50 MA and then get back above 368 to confirm, everything is done. We're out of correction territory, out of bear market territory, in bull markets. Whether or not people believe it will be the difference. So there we go. That is the intro in about 17 minutes. I'm trying to keep these videos a little bit more informative and craft the story or narrative to make it more entertaining as well. I'm going to look at, let's look at the evidence here, and then we will jump forward to talking about a few more things like options, and then we'll look at charts too to try to look at risk assets, which are currently starting to go risk on. So we talked about the BofA Bull and Bear Survey, which is currently at max bearish for the 9th consecutive week. They're fighting this thing, and that's why we're getting a whole bunch of pain, right? The pain trade. The pain trade specifically is that hedge funds are bearish on both stocks and bonds in a serious way. I'm talking to hundreds of billions of dollars. That is a lot of buying pressure. Jan Hatzius is telling us about a narrow path to avoid a hard landing. And what that basically means is that as we look here at SPY, there is a narrow window for us to reclaim this area and then not have to look back. Maybe we're going to have to do what the monthly chart says and ultimately self-fulfill our monthly chart, psychology chart, where we go into a little arrow here and then we go down. So all it's meaning is that there is still a window, but it is narrow. So we have to be very mindful of the data. And if we're not fighting the Fed, let's listen to the Fed. James Bullard has been one of the most vocal Fed officials. And on August 2nd, or again, about a week and a half, 2 weeks after we saw that BofA survey, he said, this guy was like he was the guard dog. He was the bulldog. He was the most vocal hawk or the most bearish for stocks out of all the members. Soft landing doesn't require gradualism. U.S. recession is not going to happen. Modern central banks have more credibility than the 1970s. Fed, ECB may be able to get relatively soft landings. I think the yield curve inversion is nominal. Appears both the Fed and ECB may be able to reduce inflation in an orderly manner, achieve a relatively soft landing. Is he correct? I don't know. This man seems pretty confident, and the market's a lot higher than it was on August 2nd. And that is because we're climbing the wall of worry. There are always things to worry about. I'll give you some new ones a little bit later in the show, but recession risk looks a lot less risky now. Inflation, again, got a big knock on that one. Strong dollar, it's back below our key area at 106.56. And notable, Fed hikes, now down to 50 basis points for September. Earnings revisions are not really happening, so check for the bulls. This one here, neutral. This one here, bearish. Starting to ratchet up, but I don't really want to focus on that one today, just because there ain't no party like a bull party, and these bulls are crushing it. Also, one more thing to look at here is just what I mentioned a little bit earlier this week, looking at the last 1 month. The only sector which is, other than communications, right, mixed, the only things which are not working right now are health, and specifically the ones who are virus related. So, are we also at peak virus? God forbid. All right, so now trying to understand what actually happened. So we have core inflation here, which went from, again, it looks like it peaked in March. So increasing and now decreasing. So 6.5, 6.2, 6, 5.9, 5.9. It is leveling off, right? It's leveling off as we go lower. Is this going to be a trap? I don't know. But this is the reason why the market went up. It looks like the market is extrapolating that we're going to continue the trend or just go lower. So it's extrapolating that we're just going to continue the trend and eventually meet that 2% target. That's a lot of what's baked in right now. Market is making some big assumptions. Looking at PPI, again, it's trending down, but it's not consistent either. Also looks like we peaked in March. So in March till now, the trend is down, but it's more mixed too. And to tie this together, to make it very simple, the bull case is that the Fed is going to get their soft landing. They're going to perfectly maneuver and get that soft, perfect landing right back down to 2%, and nothing is going to break. The financial system is going to stay strong, and they're not going to break anything. What market participants or the people who are still bearish are predicting is that maybe we have to go higher before we go down, or maybe that all we have to do is actually go up to about 3.5 or 4%, we level off for a lot longer, and then we come down. The green line is the current assumption for the Fed funds futures, and that's the median dot plot. So all this means is that the Fed thinks that they're going to get that perfect landing. Market believes it. Market's pricing it in. If we get more something like the pink line, that is where the market's going to have to reprice, and that is what would happen if we got 2000 or 2008, that big nasty drop. Might also happen later. I don't know. And did Powell pivot? I actually want to read this article because this one came out on, I think it was on July 28th. Yeah, July 28th, which was right around the market bottom too. I want to look at a couple of key points here. And again, with the perspective of hindsight, about 2.5 weeks later, ask yourself this. Are these economists at Goldman Sachs correct? I saw 5 reasons why the chair's comment to think the Fed will now slow the pace of rate hikes. Getting to 3.4% by the end of the year is consistent with smaller increases. Check. Powell called 75 basis point shift unusually large. Check. What does that mean? September might not get 75. It's unusually large. Powell said the full effect of tighter policies has yet to be felt. Check. The Fed will react to data rather than inflation alone. Check. He reiterated officials aim to rebalance supply and demand through soft growth, not a recession. Check. He also said we're at neutral. So, right? Which cheered investors, exactly. So that's pretty much what happened. That's the narrative from Jerome. Jerome is the Fed. He is the chair. Individual members are now starting to, again, from the dove side, right? Kashkari's been a pretty big dove for a while, and he's saying that unswayed by softer CPI, sees rate hikes into 2023. So he's saying that, hey, maybe that dot plot has to actually go up a little bit. But for now, again, we'll celebrate the bulls. This is the next thing to worry about, and notably, I would be looking at Jackson Hole for 2022, and those dates are August 25 to 27. So again, that's in about 2 weeks, and that's the next thing to worry about. If you're looking for something to worry about, that's it. That's the big one. Fed minutes on Wednesday, and then we got the FOMC summer camp on August 25 to 27. Yay, Fed! All right, moving forward. Fear and greed, like we talked about, is right at neutral. When I look at the last 7 days, everything's been pretty much working. Tesla's having some individual company issues. I don't know what's going on at J&J. Otherwise, it looks pretty good, right? Breadth, depth. Looks like risk is going on. Look at the last 1 month. Almost everything's working again, other than virus companies. Love it. Love to see that. Redder the better. Get rid of that stupid virus. And then the last 3 months, this is where I do want to see more broad participation. We note that there's mostly like 1 to a couple of red blocks inside of a sea of green, like here in technology services. We got Cisco and Meta. I'd like to see them at least get closer to neutral, if not go green. Same thing over here. We got Intel, AVGO. Over here we got Berkshire. Over here we got Walmart. Over here we got PG. We got Chevron. I'd like to see more of these flip to neutral. So we have more solid green with muted moves down. So over the last 3 months, there's still a little bit of work to do, but significant progress is being made. Significant. Why? Amazon's up 31 and is a massive block relative to Walmart, which is down by -10, and it's the same size block. sorry, same size block as HD, about half or maybe a third or a quarter the size of Amazon. So it just means Amazon is offsetting Walmart. Looking at the earnings, as I mentioned, we do have Walmart and Home Depot pre-market on Tuesday, which are going to be notable. So I'm looking right here. We got Walmart, we got Walmart, we got Home Depot. Those ones are going to matter for me. I'm also watching Target. I'll be watching Cisco because it's red, as we just noted. Kohl's, Foot Locker. Just looking at retail strength. If we're going to see weakness in the consumer, we're probably going to hear from these companies, right? Walmart, Home Depot, Target, especially the housing market for Home Depot. So not really as significant this week, but just something to be mindful of. We talked about the key dates already, so there we go. That is it. We're going to look at a few new things this week too, actually. So here we're going to have a look at options. So here we're going to look at, from our platform, actually, the algo.com. Click the link in the description if you want to find out more. What I'm going to do is, I think the feed just needs to reload here for a second. So we're going to have a look here at some options flow for this week. And at the same time, I'll just give it a second to load here. So we will come back to this. And I'm just going to have a look at the options chain for the S&P, which is coming up later this week. Why? Because there's some big flow this week. So I just want to have a look at it. And then we will go forward and have a look at some nice, juicy options. So there we go. Jumping forward here to August 15th. And again, remembering that next week is going to be monthly expiry on Friday. Here we're looking at August 15th for the 16th. So we note that there's 100,000 here at 420, and there is basically 100,000 here at 425. There's continuation up to 435 as well, which just means that the bulls think we're going to go up, with 420 being the pivot. And then we also have the bears here, which think that we're still going to go all the way back down to 420. Looking out till Wednesday, which is when we get the Fed minutes, usually muted, and no change this week. It is fairly muted. So let's close out this last one. Don't save. Let's move this up to here. Again, same thing. We got 424 to 420. And over here we got 430 and 425. So much more muted though, so we can pretty much just ignore this one. The big one that really matters is going to be next Friday. That's the big one. And we're looking at the 16s, which just means the most likely range. It does not mean that's where we're going to sit. It just means it's what's most likely. 19th, 16s, we're looking at 420, and we're looking at about 425. Over on the call side, oh boy, is it gushing. Right, we got 435 volume here with open interest. We got 430, and we got 425, which means they think we're going to squeeze hard into next Friday. That is very notable for me. So as we look forward here to, if this thing would finish loading, that would be great. Just give me a second here. So what's really interesting is just that we talked a lot about that 435 area, and we can see the motivation here from the bulls to actually get us there. So if we start making progress over 430 and higher to areas like, I don't know, about 432, 433, start to hit a lot of overhead supply there, I'll be paying very close attention. And now that we got this thing loaded up here, we can just note that, again, this is our new platform. It's getting really close to its final stage, and we are going to be relaunching soon. But what I just want to look at is going to be that for week to date, we have 63% of calls. We got 37% puts. And what I would just note is that some of these large orders are, again, still largely bearish, which means that people are still betting that we're either going to have a move down, or this is just naked insurance, right? They're buying insurance or hedging their portfolio. So there are some stocks here which are green, like American Express, Dash, Oxy, Shop. But for the most part, I'm still seeing a lot of red, which means there is still more fuel to potentially fund these things. Each one of these orders is worth, so far, at least $8 million. I'm just going to scroll down to roughly 5 million, so you can kind of see, like, oh yeah, there's like a lot of red here. So what this means is that large orders are coming in for the bears. These are all over 5 million. Every single one of these, right? QQQ, Riot, Adobe, Tip, Intel, Snap, Shop, Zillow, Sophie, right? PayPal, Ring, QQQ, Shop, Newmont, IWM, Goog. So people are betting massively against these companies, but all said and done, the call flow is still bigger. We got 2/3 of total flow coming into calls, and 1/3 going into puts, but the large orders are still skewed bearish. So it still feeds into that max bearish narrative we were just talking about from the B of A survey. All right, in a couple more minutes, we're going to wrap it up. I think I re-recorded the video because I didn't have the volume on, so I'm not sure if I actually even talked about this yet. I think we did. I think we talked about how we went down to -30 instead. Yeah, we did. We talked about this. All right. So instead, what I want to do is actually look at a couple more risk assets because I think it's really important for us to get perspective on the broader picture, meaning what is everything telling us? For DXY, what it tells us is that, again, we closed the week at 105.67, which is below 106.56, or this pink arrow, which goes back to 1989, which is when we're looking at, again, I want to see this break down for us to be bullish on stocks. I want to see us below 106.5. I want to see this cup and handle get invalidated and start going down. That's what would make me happy. There is a lot of bull evidence for DXY. We're starting to slightly come off on the weekly chart here. And we're just bouncing off the previous highs. So generally, that would be a bullish reaction unless we're able to come back down and fall back inside this pocket or the yellow box. I'd also be looking at the one-day chart because right now we are digesting or moving above and below the 50 DMA or that blue line. We technically did close below it by about 2 cents. So let's see what happens. Is this downtrend going to drag us down where we start to actually leg down and then break down? Or are we going to consolidate before going back up? I don't know. Looking back at the weekly chart, though, let's go back here to our watch list. Also want to look at the VIX. VIX is now below 20 on a weekly closing basis and has gone pretty much straight down. This is a cup and handle being invalidated. It's no longer really a cup and handle. It's just a range. That's all it is now. It's just a range. Why? Well, the cup failed to backtest and hold a key area, which was here at about the 6th of June, which is when we had that reversal on stocks. 2-year note is still red on the week, only down by 2. It's a little bit of a concern because this is a cup and handle breakout, right? Whoa, whoa, whoa. Yeah, whoa, whoa, whoa. This is flashing a mega warning too. US 10-year actually closed up on the week, so long-term inflation expectations are actually rising. So the question is this a cup and handle in the making where we're going to ultimately creep back up higher? And this would signal a stock market crash. Continuation. If we get back about 3.5, it means peak inflation is not here. I don't know what's going on in here. Is this a corrective way for us to leg down? Or is this golden cross going to lead to that cup and handle actually breaking bullish where we're going to reclaim the high and then go higher? I don't know. We're getting some early clues. Just like with inflation, that the dollar might be peaking, and just like these things might at least be leveling off. We can note that, right, 10-year note is still very elevated, 15% inversion, so hard to ignore that. Oil is taking a leg down, digesting its 50 weekly here. Again, is this a cup and handle, or is it going to be a breakdown? I don't know. As of right now, it's forming the handle part, and we're digesting that 50. Closing above it by about, 17 cents. Looking at BTC, a big risk asset. You're going to note we got a fat green line and a big red line. So if we're able to get above 25.5K, that would mean that we're going to stop going down. This is the nasty downtrend on Bitcoin we're looking at here. If we can just stop going down, maybe we can start going back up, God forbid. Same thing with Ethereum. I'm watching, and Ethereum's actually already done it. So Ethereum's already done it. So this is most impressive because the green line already got blown out. That was at 1420. So we're now dramatically above that, and we're flirting with 2,000 right now, or the next key pivot here. So if we're able to break 2K, we could shoot up to our 50 weekly at about 2,800. We could just as easily back off to about 1,700 or to 1,400 and still be perfectly bullish because we're going up and we broke our most recent downtrend. So what does that mean? We're attempting to V recover. That's why this looks like a V here. Is it going to fulfill? I don't know. If it does, we would go to 3,600. Apple, only 5% off its all-time highs, right? Falling wedge breakout, back tested and digested the 50 MA, and then just legged up. Bullish. Microsoft. These ones are important just because, again, if technology is going to lead us to the promised land, we have to watch them close. Oh, that 50 MA. I see you. It stopped going down, and it's trying to go back up. That's really notable for me. Goog. Goog is stopped going down. It has more progress to get to that 50 MA, but it's trying. Watching it close. Volume is really soft here, though. Amazon, right around a big resistance area, going back to the lows for summer of 2020, or again, the peak of the everyone wants to order stuff on Amazon. Got to be a big key pivot here too. If we can leg up, claim the 50, we could shoot up to 170, If we reject here, we could backtest, I don't know, about 130 and then have a decision. Are we going to form a W or the first impulse backtest before building up steam to go higher? I don't know, but all these things are at a key important area so far. Tesla is invalidating its head and shoulders here by getting back above the top range of 900, and it's back above its 50 MA as well. It looks like a leader, which is what? Doing a cup with a handle and maybe looking for an advancement. I don't know for sure. Looks positive though. NVIDIA, again, broke the falling wedge, needs to start going up now though. Volume looks solid here on NVIDIA too though. Elevated bullish. Meta, how's it going to hurt us more? It's at the bottom end of the pocket here, right? Anything that's not anything would be good for this one. Up or down doesn't really matter. Meta's not as relevant as it used to be. And I want to look at two more risk assets here. Then we're going to wrap it up. Oh my goodness, IWM. Oh, that's right, IWM. So we got our 2018, our 2020 highs, which were acting as support. And now what? We went mega big booms. And we're looking for a reclaim of the 50 MA. We're so close to it. That's really notable because right here at the range that I'm looking at, the box. So as the box starts to get chewed through, maybe we can go higher. And then ARC. This was my psychology chart. We can note that we're starting to invalidate it. So when the data changes, we have to take note. Right now at 52, I would note that we're right on the next key relative low and the start from when we really started to launch up. We can chew through this area too. I could see ARC going up here to roughly 60, 62 to test that downtrend, which is going to be really critical. So with that said, if you want to see the reason when we called for the bull market to be birthed and see whether or not what we talked about, I don't know, about a month or two ago is still relevant today, I encourage you to watch the video that'll keep here in a moment. Otherwise, thank you so much for watching, and I would really appreciate your support by smashing the thumbs up and dropping us a comment. Thank you for watching. Look forward to seeing you in the next video.